Welcome back. We're on countdown mode. 5 minutes away. We are awaiting the delayed January jobs report due out at 8:30 a.m. Eastern. That is 4.5 minutes away. Economists are expecting 70,000 jobs created for the month of January, with the unemployment rate declining to a level of 4.4%. We are bringing in an all-star jobs panel right now. Fox Business' Cheryl Casoni is here. Slate Stone Wealth Partner and Chief Market Strategist Kenny Polcari is here. Navalier and Associates founder and Chief Investment Officer Louis Navalier is here, and former Trump economic advisor Steve Moore is here. Plus, Entrepreneur Shares CEO Joel Schulman is here, and Job Creators Network CEO Alfredo Ortiz is here. Great to see everybody. Thank you so much for being here. And Louis, I want to start things off with you because you have long been a growth investor and have predicted a strong backdrop. What are you expecting in terms of the backdrop for jobs and economic growth this year?
Well, Wall Street's rooting for a weak number, so we get more rate cuts faster and more furious. So let's hope we get it. Now, there's a lot of seasonal adjustments in January. We'll have to dig in the details a bit.
Yeah, Steve Moore, your thoughts on where we are? It feels like we've got a good growth story, economic growth, but jobs are more questionable, partly because of the impact of AI.
This is a high-flying economy. It's hard to find anything not to like about what's going on with the U.S. economy. We'll find out in a few minutes how good this jobs report is. But I believe that it is mostly the slowdown in job creation that we've seen in hiring over the last year has really been a problem of a shortage of workers, not a shortage of jobs. We still have about 7 million job openings in this country. And as we've talked about so many times on this show, Maria, the problem is employers, over 1/3 of businesses are hiring. They are saying they just can't find the workers with the skills they need to fill those jobs.
Yeah, Cheryl Casoni, what are you going to be focused on when you actually get these numbers, the most important metrics from your standpoint?
Revisions. We're going to be looking for revisions not just for December, but that gives us an overall 2025 picture, which I think is important. We actually might get some updates to 2024. So this is going to be much more of a dearthy report than other reports that we've had in the past.
Yep.
I was looking at the estimates from Goldman. You know, they're kind of calling for about 45,000. You got Citi looking for 135,000. Wow. The range is all over the place for this one. The lowest I saw, -10 for this morning. So, look, economists are all over the place. No offense, Steve Moore.
Yeah,
but we shall see.
That's great info, Cheryl. Thanks for that. Now, Kenny Polcari, part of the growth story of this economy has been AI and how so much money is moving into AI. But recently, we saw a bit of a shock reaction to all that AI spending. And yesterday, it actually also took down the wealth managers. Your reaction?
Listen, I think at some point you have to recognize that AI is going to continue to disrupt every industry. So I'm not necessarily surprised that yesterday it attacked the wealth managers. They came out with that new tax feature. One of those companies came out with this new tax feature that was threatening or attempting to threaten, or at least that was the sense, the market reaction was that it was threatening wealth advisors. I'm not sure that that's exactly true. I think it'll help and assist, and I think it'll make the wealth advisor more nimble. I don't see that it's going to take away. So I think yesterday's reaction for the big money managers was overdone.
Alfredo Ortiz, President Trump has prioritized getting supply chains and manufacturing back to the United States. We've seen job creation there. Where are the jobs?
Yeah, absolutely. Well, you know, hospitality continues to be a place where we're seeing, especially for small businesses, growth there. And I think as the 2026 economy continues to roar, we're going to see disposable incomes continue to grow. And as we see wage growth as well, and 401ks and savings accounts and interest rates start to drop, I think people are going to start spending more money, and so we're going to start seeing hospitality numbers go up. AI is an interesting story, and I'll come back to that as well. But for small businesses, I think there's a story there as well.
And Joe Schulman, your thoughts on what to focus on in this report as well? Also, moves in the markets. Do you see money coming out of those types of ETFs that Kenny just talked about?
Well, to Cheryl's point, we're going to be looking at the revisions. I mean, clearly this is a market where not all sectors are rising equally. I mean, we see it within AI. AI is having an effect on certain publicly traded companies. We're seeing private companies like Anthropic, OpenAI, XAI really performing strongly. So this is an interesting market. This is a question of where the money is shifting. So in fact, we're going to continue to see jobs growing in healthcare and social services. We're going to see jobs disappearing in tech and AI and finance and entry-level jobs.
Market is on fire. The Dow Industrial's moving up right now, up 152. Let's get the jobs numbers right now from Cheryl.
130,000 jobs created for the month of January.
Wow.
The estimate was 70,000. Wow, I was right, Maria. 4.3% is the unemployment rate. The street was looking for 4.4%. This is not the kind of report we expected to see, guys. Let me give you the government jobs picture. That is negative 42,000 on the government side part of the equation. We saw that in the reports previously. We also saw a labor force participation rate, 62.5%. Average hourly earnings, 0.41%. That is actually higher than the expectations. So average hourly earnings month to month, a little bit higher than expected. Private payrolls, 172,000. I had to do a double take. 172,000 private jobs. Guys, that's 100,000 above the estimate. We were looking for 70,000. The average work week, 34.3 hours. Let me get into the report here and give you a sense of what the government is saying about where the jobs are. We've seen healthcare, we've seen retail, but basically, where is this? Let's see here. Healthcare, social assistance, construction. Those were where they saw the buildup in jobs. The decreases they saw, as I mentioned, federal government and also financial activities. They're mentioning a job loss in those two sectors. So that's actually very interesting as well. But again, a very different story, Maria. I am seeing the U.S. dollar right now strengthening on my screen, and I'm seeing the Treasury yields really jump after this report. I'm going to dig more into the specifics and send it back to you.
We'll be back to you shortly, Cheryl. Thanks for that.
By the way,
Louis Navalier, Steve Moore, go ahead.
Huge downward revision in the past months.
Yeah, that's what I was expecting.
Huge.
Yeah.
So
that's what I was saying. Tell us how huge it is. That's what I've been saying all morning.
Yeah.
Go ahead.
Yeah, if I'm reading this right, and Cheryl may, it looks like 800,000 jobs revised down.
That's what Zero Hedge reported, that it was going to be close to a million. Yep. Yeah, so it's 800,000 revision.
860.
You're saying for the month of December.
That's right, and I'm looking now.
Go ahead, Cheryl. What's the number?
I'm sorry. The revision for December, the number was revised to 48,000. November was revised higher, 41,000. So we did get November and December revisions. So I wanted to give you the specific numbers.
And the revision was sharply lower for the month of December, Cheryl.
Yeah, the original number for December was 50. So this is actually a little bit lower. Not by a lot, just to be clear, but yes, it was a little bit lower.
All right. Louis, what's your take on these numbers? Much better than expected job creation in the month of January.
Well, we just have to look at the bond market reaction, and if bond yields go up a little, then that means the Fed can postpone their rate cuts. But, you know, the yield curve is the steepest in 4 years, and they're going to be cutting probably when Warsh gets in.
Now, the confirmation hearings for Kevin Warsh are expected to begin in March, widely expected to be confirmed and be our next chairman of the Fed. You're expecting 3 rate cuts, Louis.
That's right. And Kevin's a big proponent of not doing quantitative easing. So we expect he'll shrink the Fed's balance sheet. But he's going to be working with Scott Bessent. Those two know each other very well.
In fact, I spoke with Scott Bessent specifically about the balance sheet. Let's roll that, because you're looking at the 10-year yield right now up 6 basis points, up to 4.2%. I want to get Kenny Polcari's thoughts on this. First, here's Scott Bessent with me Sunday. Now that we've got growth as a priority and you've got the economy where you want it as you rein in inflation, is it fair to say that the Federal Reserve's adoption of these large-scale asset purchases should be wound down?
Again, that'll be up to the Fed in terms of what they want to do with the balance sheet. I wouldn't expect them to do anything quickly. They've moved to an ample regime policy, and that does require a larger balance sheet. So, I would think that they'll probably sit back, take at least a year to decide what they want to do. It's pretty clear to me. I wrote a 7,000-word essay in the International Economy magazine. I called it gain of function monetary policy.
That's right.
Saying that the Fed had gotten kind of out of control, and I think that Kevin Warsh is going to be very independent. but mindful that the Fed is accountable to the American people.
Kenny Pocari, big move in stocks right now. Dow Industrial's up 227. We're at the highs of the morning. Your reaction?
Look, I think it's great, right? I think that number was a complete surprise considering everyone was talking about disaster, disaster. Oh, my God. I think it speaks to the strength of the economy. It speaks to how robust it is. And it doesn't, it doesn't speak to we need a rate cut tomorrow. We're not going to get one. But it only speaks to a rate cut if they, in fact, start to shrink the balance sheet. That's the only way that I see them cutting rates. So if they cut them 3 times this year, as Louis wants, I think they have to then, in unison, shrink the balance sheet to make that work.
Now, most analysts are expecting 2 rate cuts from the Fed this year. Louis is expecting 3, and a handful of others are expecting 3. But for the most part, I think most are expecting 2. But Alfredo, what do you want to say about this jobs report? Much better than expected at 130,000 jobs created for the month of January.
Yeah, this is an excellent report. I mean, we continue to see the private payroll sector continue to grow, government payroll go down, which is exactly what the Trump administration has wanted to. We are now, again, a consumer-centric economy, not necessarily funded by the government and taxpayers. And so we love seeing that. We love seeing the real wage growth. I think that's critically important. And as I mentioned on the AI front, over the past few years, I think there's been a little bit of kind of a cycle here that's gone from what is AI to basically which AI to now how do we use AI from a productivity standpoint. And whereas I think it used to be a big company tool, I think small businesses now are looking at AI and saying, what can we do with that to increase our productivity? And I think there's a big opportunity there for continued small business growth.